Hello friends, this is Surya. Let us learn some of the key terms of economic concepts and analysis for CPA BEC section.
BEC 2019 Terms and Glossaries, Economic Concepts and Analysis. Benchmarking. Benchmarking relates to determining best practices and, often, using those practices as standards. Business cycle. The business cycle is the rise and fall of economic activity relative to its long-term growth trend. During a contraction or a recession, most industries experience a decline in sales and profits. Similarly, during an expansion, most industries experience an increase in sales and profits. Business cycle sequence. The sequence of a typical business cycle includes an expansionary phase, a peak of economic activity, a contractionary phase, and a trough of economic activity. Collusive pricing. Collusive pricing anticipates that competitors will collude or conspire to maintain prices and mutual profitability. Collusive pricing undermines competitive pricing and maintains prices to external customers at levels higher than they would be in a competitive marketplace. Complementary goods. A rise in the price of a complementary commodity would cause a shift to the left in any demand curve, representing decrease in demand, at all price levels, for that product. With respect to complementary goods, the demand for the primary product is directly impacted by the demand, and hence the price changes, for the complementary goods. Complementary goods. Two goods are complements if they are used together or their demand curves move together, breakfast cereal and milk, example, or tennis balls and tennis rackets. Thus, if the price of one complement goes up, demand for the other good goes down. Complementary goods. Complementary goods are ones whose demand fluctuates together. If good A and good B are complements, then if the demand for good A increases, the demand for good B will also increase. Tennis rackets and tennis balls are complements. Complementary goods. The demands for mutually complementary goods fluctuate together, example, more cereal purchases are accompanied by an increase in the demand for milk. Consumer Price Index. The CPI is a measure of the overall cost of a fixed basket of goods and services purchased by an average household. It is primarily used to compare relative price changes over time. Consumer Price Index. The Consumer Price Index is a measure of the inflation rate, the percentage change of the Consumer Price Index from one period to the next. It is only one measure of inflation. There are others, such as the Producer's Price Index, but the Consumer Price Index is the most widely known and used. Continuous Quality Improvement. Continuous quality improvement represents an unswerving focus on customer satisfaction and quality, not necessarily the specific steps associated with value chain analysis. Contraction/recession phase of business cycle. When potential national income, potential gross domestic product, also referred to as the long-run aggregate supply, is greater than the achieved national income, the short-run aggregate supply curve is shifting to the left, indicating a contraction or recession. Cost, push, inflation. Cost, push, inflation is inflation caused by a shift left in aggregate supply. An increase in input costs, such as a sharp increase in the price of oil, will cause the short-run aggregate supply curve to shift left and thus increase the aggregate price level, causing inflation. Cost leadership. Cost leadership focused on a broad range of buyers would emphasize price to a large number of buyers, not various features. Cost leadership focused on a narrow range, niche, of buyers would emphasize price to a specific group interested in price. Cost of product. In microeconomic analysis, in the long run all supply-side inputs are variable. In accounting terms, this means that in the long run all costs are variable. Example: the fixed cost of depreciation of a factory building becomes a variable cost when a second factory building is added. Cross-elasticity. Cross-elasticity, not the demand curve, measures the impact that price has on the purchased amount of to related goods, either substitute or complement. Cyclical unemployment. Cyclical unemployment results from declining GDP and would not likely be created by technological advances. Cyclical unemployment. Cyclical unemployment is due to a downturn, recession, in the economy which leads to a decline in real GDP and higher unemployment. Deflation. Deflation is a general decline in the overall price level, i.e., when the inflation rate is negative. Increasing the money supply causes the overall price level to rise. As a result, it helps eliminate deflation. Demand curve. The demand curve illustrates the maximum quantity of a specific good that consumers are willing and able to purchase at each and every price, all else being equal. Thus, the demand curve reflects the impact that price has on the amount of a product purchased. A decline in interest rates would cause the aggregate demand curve to shift right, which increases real GDP. A decline in input costs would cause the aggregate supply curve to shift right, which also increases real GDP. Differentiation. Differentiation focused on a narrow range, niche, of buyers would differentiate the product within the context of a very few buyers and might specifically emphasize one feature such as prestige, for the status-conscious professional, performance, for the auto enthusiast, or safety for families, etc. Disposable income. Disposable income is computed as personal income, the income received by households and non-corporate businesses, net of personal taxes. Disposable income is the amount left over from personal income that is available either to spend or save. Dual pricing. Dual pricing invokes appropriately assigning different prices to the same product in different market settings. Dual pricing is a sophisticated extension of competitive pricing. The prices are simply established at the levels appropriate for each market and would not result in higher prices than would be experienced in competitive markets. Economies of scale. In the long run, a firm may experience increasing returns due to economies of scale which come into full play only if a large enough number of units is being produced to make it worthwhile to set up a fairly elaborate productive organization. Elasticity of demand. Demand is elastic if a decline in price, P, results in an increase in total revenue, TR, or if an increase in P results in a decline in TR. On the other hand, if demand is inelastic, a decline in P will result in a decline in TR or an increase in P will result in an increase in TR. A price elasticity of demand of 2.0 means demand will change by 2x, as a percentage, for any change in price. This is called elastic. Perfectly elastic demand does not exist. Perfectly inelastic demand means the quantity demanded will not change when price changes. Inelastic demand responds less than 1x, as a percentage, for a change in price. Elasticity of demand. If demand is relatively elastic, then the reduction in price will, by definition, produce a proportionately greater increase in quantity demanded. Hence, total revenue will increase. Elasticity of demand. Quantity increases will be proportionally more than price declines if product demand is significantly elastic. Price elasticity of demand change in price. Values of the price elasticity of demand ratio greater than 1.0 are considered to be elastic. The demand elasticity presumed by the fact pattern equates with a price elasticity measure greater than 1.0 and, therefore, proportional changes in quantity are greater than changes in price. Values of the price elasticity of demand ratio greater than 1.0 are considered to be elastic. The demand elasticity presumed by the fact pattern equates with a price elasticity measure greater than 1.0 and, therefore, proportional changes in quantity are greater than changes in price. Elasticity of demand. Demand for a product tends to be price inelastic if few good substitutes are available for the product. Even if price increases, consumers are unable to switch to substitute goods, because they don't exist. Luxury items may have good substitutes available. Complementary goods are those whose demand fluctuates in unison. If consumers spend a large share of their income on the product, they will be very sensitive to any price changes and hence product demand would be more elastic. Elasticity of supply. Price elasticity of supply is calculated the same way as demand except that quantity supplied is measured. Price elasticity change in quantity supplied. Of supply, percent, change in price. Perfectly inelastic supply curves are also vertical, representing that supply is insensitive to changes in price, i.e., the quantity supplied will not change as price changes. Equilibrium. Government price regulations in competitive markets that set maximum or ceiling prices below the equilibrium price will create shortages of that product in the short run because quantity supplied will be less than quantity demanded at that price. Maximum or ceiling prices below the equilibrium price will create shortages. Minimum or floor prices above the equilibrium price will create surplus. Equilibrium. The competitive model predicts a surplus is created when supply exceeds quantity demanded at that price. Hence, a surplus occurs when minimum price is set above equilibrium. Equilibrium price. A government price support program acts as a subsidy that will encourage suppliers to increase supply beyond an equilibrium point, the point where supply and demand curves intersect. This excess of supply over demand will create surpluses in the market. Equilibrium price. Setting a maximum or ceiling price, which is below the equilibrium price dictated by a competitive market, would result in a shortage as a result of excess demand. Expansionary monetary. Expansionary monetary policy results when the Fed increases the money supply. Expansionary monetary policy affects the economy through the following chain of events. 1. An increase in the money supply causes interest rates to fall. 2. Falling interest rates stimulate the desired levels of firm investment and household consumption. 3. Increases in desired investment and consumption cause an increase in aggregate demand. And 4. Aggregate demand shifts to the right, causing real GDP and the price level to rise. Expansionary policy. Under an expansionary policy, the Federal Reserve would most likely purchase government securities. Purchasing these securities increases the money supply and expands the economy. Reducing the reserve requirement will expand the economy, not dampen it, because there will be more money to loan. Under contraction policy, the Federal Reserve would most likely raising the discount rate will dampen the economy. Raising the reserve requirement will dampen the economy, because there will be less money to loan. Federal bank discount rate. The federal bank discount rate refers to the rate established by the Federal Reserve for short-term loans it makes to member banks. Fiscal policy. As a contraction policy, the economy can be dampened by reducing government spending and by increasing taxes, thus giving consumers less money to spend. The economy can also be dampened by reducing the money supply, thus effectively increasing prices, and increasing interest rates, thus giving consumers less money to spend because they are spending more money on interest, both of which are monetary policy. Frictional unemployment. Frictional unemployment is the unemployment that arises from workers routinely changing jobs or from workers being temporarily laid off. It results from the time needed to match qualified job seekers with available jobs. Frictional unemployment. Frictional unemployment is normal unemployment resulting from workers routinely changing jobs. Frictional unemployment would likely not result from technological advances. Frictional unemployment. Frictional unemployment exists when workers are in the process of changing jobs or are temporarily laid off from their jobs. Globalization. Globalization represents the increased dispersion and integration of the world's economies. Globalization is often objectively measured as the growth in world trade as a percentage of GDP. Gross domestic product. The expenditure approach to computing GDP includes exports and other components included in the mnemonic GICE. Government expenditures. Capital investment. Consumption. Net exports. Gross domestic product, GDP. Gross domestic product, GDP, is the total dollar, monetary, value of all new final products and services produced within the economy in a given time period. The emphasis is on the final goods and services. Gross Domestic Product, GDP. Gross Domestic Product, GDP, is calculated in two different ways, 1. Expenditure approach and 1. Income approach. In expenditure approach, GDP can be calculated with the mnemonic GICE. G. Government purchases. I. Private domestic investment. C. Personal consumption expenditures. E. Net exports. Inferior good. An inferior good is one for which the demand declines as income increases. A normal good would experience an increase in demand in response to an increase in income. Because the demand for hamburger went down as income increased, it is an inferior good. Internal costs analysis. Internal costs analysis includes analyzing the internal value-creating ability of a firm, so the sources of profit and costs of the internal activities of the firm must be analyzed. Law of diminishing returns. The law of diminishing returns states that an increase in labor or capital beyond a certain point causes a less than proportionate increase in production. Fiscal policy. Increase in money supply. If the Federal Reserve were to buy U.S. Treasury bonds, that would increase the money supply. Increasing reserve requirements would mean less lending because banks would have to hold a larger portion of amounts deposited in reserve. If the Federal Reserve wanted to increase the money supply, it would reduce the discount rate. A lower discount rate would reduce short-term interest rates, which would encourage more short-term borrowing at the lower interest rate. Lower cost means more demand. More borrowing means more lending and more money in the economy. Decrease in money supply. Selling more U.S. Treasury bonds would reduce the money supply since the bonds would have to be paid for with money out of the money supply. Monopolistic competition. A market with many independent firms, low barriers to entry, and product differentiation is best classified as monopolistic competition to entry, and firms exert some influence over price in such a market. Best examples are brand name consumer products price in such a market. Best examples are brand name consumer products. Monopoly. When there are few good substitutes for a supplier's product, the supplier has market power. Think of a monopoly. As a result, the supplier is better able to control buyers and act as a price setter rather than a price taker. Natural unemployment. The natural unemployment rate is the sum of frictional, structural, and seasonal unemployment, or the unemployment rate that exists when the economy reaches its potential output. Peak. A peak is the highest point of economic activity. It is the point where real GDP is at its highest level in the cycle and unemployment is at its lowest level in the cycle. Peak. The peak of a business cycle marks the highest point of economic activity. At that point, firms are likely to face capacity constraints and labor shortages, which will put upward pressure on the overall price level. Perfect competition. Factors of perfect competition increase the bargaining power of the customer. These are: customers make up a large volume of a firm's business. There is much information available to customers. The buyers have low switching costs. There are a high number. Perfect competition. Factors that impacts competition to be an even stronger force impacting the profitability of a firm. The market is not growing fast. There are several equal-sized firms in the market. Customers do not have strong brand preferences. The costs of exiting the market exceed the costs of continuing to operate. Some firms profit from making certain moves to increase market share. The various firms in the market use different types of strategic plans. Perfect competition. When suppliers' products are not differentiated, buyers will be indifferent about which supplier they purchase from. In other words, if firms sell identical products, think of perfect competition. The product of one firm is a perfect substitute for the product of another firm. In this case, firms are price takers, not price setters. Perfect competition. A key assumption of perfect competition is that the firm is a price taker, that is, it cannot fix the price. Key assumptions of perfect competition include: customers are indifferent about which firm they buy from. The level of a firm's output is small relative to the industry's total output. There is freedom of entry into and exit out of the industry. Perfectly inelastic. When a good is demanded, no matter the price, demand is described as perfectly inelastic. The demand curve is a vertical line at the quantity demand with price making no difference. Personal income tax. An increase in the personal income tax will cause a decrease in aggregate demand, i.e., causes the aggregate demand curve to shift left. As a result, an increase in taxes causes real GDP to fall and unemployment to rise. Predatory pricing strategies. Predatory pricing strategies typically result in lower prices to external customers than competitive pricing. Predatory pricing, below market or even below cost, is undertaken by larger organizations that can absorb losses and deliberately do so in an attempt to break smaller, less capitalized, competitors from the marketplace. Principle of Comparative Advantage. The principle of comparative advantage states that even if one of two regions is absolutely more efficient in the production of every good than is the other, if each region specializes in the products in which it has a comparative advantage, greatest relative efficiency, trade will be mutually profitable to both regions. Real wages of productive factors will rise in both places. This principle is the basis for international trade. Principle of Comparative Advantage. The principle of comparative advantage states that even if one of two regions is absolutely more efficient in the production of every good than is the other, if each region specializes in the products in which it has a comparative advantage, greatest relative efficiency, trade will be mutually profitable to both regions. Real wages of productive factors will rise in both places. This principle is the basis for international trade. Principle of Substitution. The principle of substitution states that people tend to shift their buying from relatively expensive to relatively cheap goods. Thus, if the price of a product falls, people tend to buy more of it and less of other, relatively, more expensive products. Principle of Substitution. The principle of substitution states that people tend to shift their buying from relatively expensive to relatively cheap goods. Thus, if the price of a product falls, people tend to buy more of it and less of other, relatively, more expensive products. Real GDP per capita. Real GDP per capita is real GDP divided by population. Real GDP per capita is typically used to compare standards of living across countries or across time. By dividing real GDP by population, this measure adjusts for differences in the size of countries and for differences in population over time. Recession. A recession is defined as a period of falling GDP and rising unemployment. GDP will fall if there is a decrease in aggregate demand or a decrease in aggregate supply. Score mode. The score model includes a series of processes or steps defined as plan, source, make, and deliver. Plan. The process of planning consists of developing a way to properly balance aggregate demand and aggregate supply within the goals and objectives of the firm and plan for the necessary infrastructure. The process of planning consists of developing a way to properly balance aggregate demand and aggregate supply within the goals and objectives of the firm and plan for the necessary infrastructure. Assessing the ability of the suppliers to supply resources is part of the plan process. Source. Selecting vendors is a source decision, not a plan decision. Selecting vendors is a source step that implements that plan. Once demand has been planned, it is necessary to procure the resources required to meet it and to manage the infrastructure that exists for the sources. Collecting and processing vendor payments falls into the source process. Make. The make process encompasses all the activities that turn the raw materials into finished products that are produced to meet a planned demand. Implementing changes in the engineering process falls into the make process. Deliver. The deliver process encompasses all the activities of getting the finished product into the hands of the ultimate consumers to meet their planned demand. Managing accounts receivable and collections from customers falls into the deliver process. Short-term unemployment. Short-term unemployment is a broad description that relates to the duration of an unemployment condition. The duration of unemployment can be caused by any number of factors. However, structural influences such as technological advancement that require workforce retraining would likely not be short-term. Structural unemployment. Technological advances would likely result in structural unemployment. Structural unemployment is characterized by available jobs that do not match the skill sets of the workforce. Technological advances could create jobs that simultaneously make the skills of the workforce obsolete. Structural unemployment. Structural unemployment occurs when the jobs available do not match the skills of the unemployed individuals or when the individuals do not live where jobs are available with their skills. Substitute goods. For substitute goods, as the price of one good goes up, the demand for another, substitute good increases as consumers desire the lower priced substitute good. Superior goods. Just as the demand for inferior goods declines with an increase in the income level of a consumer, superior goods will experience a spurt in demand as prices are raised. Supply and demand shift. When the supply of and demand for a good both increase, equilibrium quantity increases. However, the impact on price is indeterminate. If demand and supply increase by the same amount, price will remain unchanged, as illustrated above. However, if demand increases by more than supply, price will increase. Conversely, if supply increases by more than demand, price will decrease. Supply curve. The supply curve measures the maximum quantity of a specific good that sellers are willing and able to produce at each and every price. Supply curve. The movement of points along the supply curve represents a change in quantity supplied as a result of a change in price and is the measure of a willingness of producers to offer a product at alternative prices. Swot Analysis. Evaluation of internal and external factors contributing to an organization's success is referred to as strengths, weaknesses, opportunities, and threats. SWOT analysis. Strengths and weaknesses focus on internal factors while opportunities and threats relate to external factors. Theory of Economies of Scale. The theory of economies of scale states that, as a production process gets larger, the process becomes more efficient and productivity increases. The theory of diminishing return is the opposite of economies of scale in that it holds that, as more product is produced, the factory gets less productivity out of its workforce and machinery. Factors contributing to economies of scale include labor specialization, managerial specialization, utilization of byproducts, or joint products, efficient use of capital equipment, volume discount purchasing. Theory of economies of scale. In the long run, a firm may experience increasing returns due to economies of scale which come into full play only if a large enough number of units is being produced to make it worthwhile to set up a fairly elaborate productive organization. Transfer pricing. Transfer pricing is the charge made between affiliates for products or services. Transfer prices may be at any level including cost and market and do not relate to the establishment of prices to external customers. Trough business cycle. A trough is the lowest level of economic activity. It is the point where real GDP is at its lowest level in the cycle and unemployment is at its highest level in the cycle. Trough business cycle. The trough of a business cycle is an economic low point with no positive indicators for the future. It is characterized by unused productive capacity and an unwillingness to risk new investment. Value chain analysis. The process of developing macro-level flow charts of business processes that produce products or services and then identifying the value added by each process is referred to as value chain analysis.
Thank you very much, friends. Keep on repeating these key terms to memorize and to pass BEC section of CP examination. Subscribe my YouTube channel for updated information. Thank you very much. Have a wonderful day.